Good afternoon, grade 12 learners. My name is Mr. Simbi, and welcome to today's accounting class. This lesson is brought to you by the Gauteng Department of Education in collaboration with Sabono Discovery Center. Every Friday at 2 p.m., we meet here and we are going to be doing calculations. It is very important that you tell your friends that classes are happening. You don't have to miss these classes because we are preparing. Remember, the examinations are already around the corner. So you need to keep studying, you need to keep practicing. In the previous weeks, we've covered ledger accounts. We've also done the statement of comprehensive income. We did, I think, about 3 statements of comprehensive income. And then today, I'm going to start off with the statement of financial position. The statement of financial position. But in every class, I'm going to be talking about certain things that may not directly relate with that particular topic. So if you need to know concepts in accounting, you need to watch these classes. Here are my objectives for today's lesson. I will explain the difference between an internal and external auditor. So if you struggle with the difference between an internal and an external auditor, I will explain these today. In this lesson, I will also complete the statement of financial position, the balance sheet. So if you struggle with this thing, it is very important that you follow today's class. All right? Here are the things that I require you to have. You need to have a paper, you need to have a pen, you need to have a calculator as well so that you are able to calculate. It is very important that when I do calculations, you all also follow through. In today's paper, we're going to be focusing on Mpumalanga 2023 prelim paper. So if you have it already on your phone, just have it ready because we're going to be doing calculations from that particular paper. I'll be focusing on Mpumalanga 2023 prelim paper. That is where we're going to have our statement of financial position from. But before we begin with the statement of financial position, let us talk a bit about the difference between an internal and external auditors. Let's start with internal auditor. An internal auditor is employed by the company. Very key that the internal auditor is employed by the company itself. Therefore, this person is on the payroll of the company, paid by the company. When we pay our salaries and wages, we also pay our internal auditor, employed by the company itself, and is also on the payroll of the company. The internal auditor reports to the management or board of directors. Very key that the internal auditor reports to management or the board of directors. Let's move on to the next one. The internal auditor primarily focuses on evaluating and improving the effectiveness of internal controls, risk management processes, and governance procedures within the company. So this is his primary focus, all right? Evaluating and improving the effectiveness of internal controls. So this is his responsibility to ensure that internal control measures are working properly. And then another point, the internal auditor conducts regular audits to assess compliance with policies, procedures, and regulations. So when you think about an internal auditor, one of his tasks is to conduct regular audits, to ensure that there are regular audits that are happening in the company to assess compliance, that is, with policies, procedures, as well as regulations. I hope you're taking these notes down because questions can come and then you have to differentiate between an internal and an external auditor. So what I'm doing now, I'm busy explaining the duties or the roles that are played by an internal auditor. And then he identifies areas for improvement and provides recommendations to enhance operational efficiency, reduce risk, and strengthen internal controls. So this becomes the last point in relation to the internal auditor, that the internal auditor identifies areas for improvement and provides recommendations to enhance operational efficiency and then reduce risk and strengthen internal controls. These are the tasks, the roles, and the duties that are performed by an internal auditor. Now that we understand that the internal auditor is employed by the company itself, and we now understand the roles and what he does in the company, let's look at the external auditor. What is an external auditor? An external auditor then is an auditor that is independent from the company, and this one charges a fee. You remember what we said earlier on about the internal auditor is employed by the company itself, is on the payroll of the company. But the external auditor now is independent from the company. He charges a fee. You can already see the difference between the internal and the external auditor. The next point is that the external auditor reports to shareholders or regulatory authorities, depending on engagement. So remember, the internal auditor was reporting to management and the board of directors, but now you can hear the external auditor reports to shareholders or regulatory authorities. It is very important that you can get that difference between your internal as well as your external auditors. The external auditor mainly focuses on providing an independent and objective assessment of the accuracy and fairness of the company's financial statements. All right, so this is one of his key roles, all right, of the external auditor, that is to focus on providing an independent and objective assessment of the accuracy and fairness of the company's financial statements. And then number 4, the external auditor is to express an opinion on whether the financial statements present a true and fair view of the company's financial position and performance. This is very important when you talk about audit reporting. That is, when an external auditor then gives a report, this is where they express an opinion on whether the financial statements present a true and fair view of the company's financial statement, financial position, and performance. We are now going to start the preparation of our statement of financial position. As I said earlier on, we're going to be focusing on the Mpumalanga 2023 prelim paper. Okay, now in grade 10, you dealt with a sole trader. Remember, the one-man business. Now, the sole trader was what we did in grade 10. And when we were in grade 10, we're also able to prepare what was known as the balance sheet, that is your statement of financial position. But with the sole trader, you would remember that you had this honest equity and you were preparing note number 7, and then you just have your capital. All right, that is how we were presenting it in the balance sheet in grade 10. We just have a capital note, and then you would have your amount there, as you can see, 200. That is what would form the owner's equity. That is what we did in grade 10. And the year that followed, that was the previous year now, we did our grade 11. In grade 11, we did what was known as the partnerships. In our partnerships, we then did note number 7, but we added another note again. That was note number 8, your current accounts. So these two then, when added, would give us what we were calling our partner's equity. So the partner's equity in grade 11 was formed from the capital as well as the current account. That was grade 11. Now that we are in matric, in grade 12, our equity in the company is now formed of 2 notes. The first note is your ordinary share capital note, note number 7. All right, this is where we record the issue of shares and the repurchase of shares. Then we would know the balance at the end of the financial year. That is our shareholders' equity. The shareholders' equity is formed of 2 notes, ordinary share capital, and then the retained income. In today's class, I'm going to do these 2 notes. I'm going to do my ordinary share capital note. I'm also going to do the retained income note. If you struggle with these 2 notes, today maybe your lucky day. So you're going to do certain calculations with me today. So please make sure you have somewhere to write. And then I want to encourage you, please just tell your friends that class is already on, and let's get busy with some calculations. You would remember, I think from grade 8, that we were doing what was known as the accounting equation. The accounting equation, you remember that. That is, your A is equal to, or E plus L. Do you still remember what your A represented? Your A represented your assets. That is correct. And we would say assets is equal to owner's equity plus our liabilities. Now, when we are preparing the statement of financial position, we have to remember that our owner's equity and liabilities, this is how you raise money, how you raise your capital. All right. So we have our owner's equity. This is own capital. Then we have liabilities. This is borrowed capital. So shareholders' equity and liabilities is formed of the owner's equity and the liabilities. This is how we raise money, how we raise capital. After we have raised the capital, then we invest the capital that we've raised. But we invest it in what we call assets. All right? This is how you invest the business's funds. So I want you to understand that when we are doing our statement of financial position, that is the balance sheet, we are still going to follow the same format that we were using in grade 10 and in grade 11. And the accounting equation will still hold. That is, your assets are equal to owner's equity plus liabilities. Okay, now we want to expand on this accounting equation. We want to see if we can add some assets, some owner's equity and liabilities. Let's now begin with the format. So as I teach you the format, make sure that you have somewhere where you're writing, because I'm about to explain the format of the statement of financial position to you. Let us go. Here's the format. Remember, I spoke about the assets is equal to owner's equity and liabilities. So my focus to begin with is going to be on my assets. On my assets, you would remember that even in grade 10 and in grade 11, you have two classes, if I'm to say, of assets. The first one is what we call our non-current assets. Non-current assets. These are assets that are not acquired for repurchase. We acquire them to use them in the business. All right? So we acquire them so that we can keep them and use them in the business. And these assets would last in the business for more than one financial year. So I would then explain it simply to say these are assets that last for more than 12 months. So I can say 12 months plus. 12 months plus. Assets that will last in the business for more than one financial period. These are your non-current assets. And we will be talking about our tangible or fixed assets. In the previous class, we did note number 3. So you can follow and learn from the previous class how we can complete note number 3. But again, probably next week or the week that is to come, I'll still do another note 3 with you. All right. So when we talk about our non-current assets, we are looking at our fixed tangible assets. And then the next part to our non-current assets are what we call financial assets. That is your fixed deposits. These are the investments that we've made, all right? And in today's class, I'll also give you an example of such an investment. And then one aspect that examiners love is to test when that investment is going to mature. What do we do when that investment is going to mature? I'm going to show you in today's class. Then the next one is what we call current assets. So far, we've spoken about non-current assets. Let's now begin to talk about our current assets. When we talk of current assets, we're talking of assets that exist in the business for 12 months or less. All right. And then the first good example is our inventory. All right. So you can see I'm arranging them in the order of ascension. In other words, I have note number 3 here, and you can see I have note number 4 there. So they will be going down like that. Are we together? And then the first one is inventories. We are talking about your trading stock here. Inventories, your note number 4. The next one to follow is your trade and other debtors, trade and other receivables. That is your note number 5. And then lastly, under your current assets is your cash and cash equivalents. Remember, I told you about that fixed deposit that matures within 12 months. I'm going to do a calculation with you to show you how we would record that. When you have your non-current assets and your current assets, we will then have what we call total assets. So our total assets is an addition of our non-current assets and our current assets. That is how we get our total assets. Now that we have the A part of the accounting equation, let's go look at the next part. The next part is our equity and liabilities. Our equity and liabilities. Now, our equity is formed, as I said earlier on, by 2 specific notes. The first one is your ordinary share capital. Remember, this is where we record the issue as well as the repurchase of shares. And then the next one is your retained income. Your retained income, I'm going to teach that note today. So please make sure you follow through. And then when you add these 2, you will then have what is known as your shareholders' equity. These are the new items in grade 12. Remember, I showed you the difference from grade 10, grade 11, and these become the new aspects in our matric year. Now, I'll go on to what we call non-current liabilities. Did we talk about non-current something earlier on? Yes, we spoke about non-current assets. And what did we call them? Assets that exist in the business for more than 12 months. So now we have non-current liabilities. What do you think they are? Definitely, these are liabilities that will be in the business for more than 12 months. All right, for 12 months and more. These are liabilities that the business will pay for more than 12 months. And a good example, it is your mortgage bond. Okay, this is when their maturation period is longer than 12 months. But then what happens when a part of this loan is going to be paid within 12 months? I'm going to show you in today's class how we do such calculations. Then the last part of our equity and liabilities are what we call current liabilities. Our current liabilities are liabilities that last for 12 months and less. And with these ones, the first example is what we call trade and other creditors. All right, these are your trade and other payables. And we open a note number 9. Do you see what I was talking about earlier on? We had note number 3, we came to 4, we went to 5, went to 6, then now we see 7, 8, and then note number 9. Then we will also show our bank overdraft. And I will show you today your short-term loans. Okay, and then once we add our shareholders' equity, here, our non-current liabilities and our current liabilities, we will have our total equity and liabilities. Remember, at the end of the day, this year, you have to get as much marks as possible. All right. Whenever you sit down to write a particular paper, you have to ensure that you pick as many marks as possible. And in order for you to get marks on your statement of financial position, you have to, number 1, you should know your format. This is the standard for you to get marks. Knowing the format, we cannot compromise on that. You have to know your format. So you have to practice your format when you're at home. When you're at school, continue practicing your format. Once you know your format, you know what to place where. The statement of financial position becomes very easy for you. And then after that, we then go and we treat our adjustments. But you also start with pre-adjustment figures from the trial balance. So you will see, I'll also do that today, where I take amounts from the pre-adjustment trial balance, then I place them on the face of the statement of financial position. Then later, we do adjustments. Number 2, start with the balance sheet account section. So you know that on your trial balance is split into two parts. The first one is the balance sheet account section, then the nominal account section. So when we're preparing our statement of financial position, where do we begin? We begin first with the balance sheet accounts section, and then record the figures in the balance sheet to earn part of remarks. Start with adjustments, that is in the nominal account section, and within the adjustments, that is where more marks are allocated. All right, I know now you want us to start with the activity. Okay, so let's begin. Make sure your calculator is ready because I'm going to be doing certain calculations with you. All right, let us begin. Activity 1, that is from Mpumalanga 2023 prelim paper. Let's begin. The question reads, King Limited, the financial year ended 20th February 2023, required complete the following notes to the statement of financial position. The first one is ordinary share capital. What note number is this? Note number what? Thank you. Note number 7. You're correct. And then we're also going to do retained income. What note number is that? Note number 8. And then we then prepare the statement of financial position for February 2023. Let's look at the information that was provided. So we're given an extract from the records on 20th February 2023. Very important that you use this information as you prepare. And then apart from that, we were given additional information as well. Here is the first part, and this relates to our share capital and dividends. Share capital and dividends. Furthermore, we were given adjustments. We have adjustment C up until G. Okay, so if you're ready, I'm going to do them slowly so that you can follow. Okay, I'm going to be doing them slowly so that you can follow. Give me a signal if I must start. Okay, thank you. All right, let's begin. Let's start. So the first thing we're going to do is to complete our ordinary share capital note. Okay, I know some of you have challenges with this note. Please stay close because we're going to do this one together. Now, we are told share capital and dividends. In the first 10 minutes that you're given for every exam, learn to read the information properly. And remember, we read the question paper together with the answer book. I'm going to be saying these things every single Friday until we go and write our final exam. We read the question paper hand in hand with the answer book. Can I go? All right. Then we have authorized share capital. All right. We've spoken about this. If you still have challenges with what is authorized share capital, go to the lesson we did on this place on the 26th of January. You will find all the information and all the calculations in there. So we have our authorized share capital of 3 million ordinary shares. Then we have issued some shares. Let's hear. On the 1st of March 2022, 40% of the authorized ordinary shares had been issued. 40% had been issued. So what that means is, out of this 3 million that you see here, we had issued 40%. So that means I'll come and say my 3 million, multiply this by 40 over 100. Let's see if we can do this together. So I have my 3 million here. There is my 3 million. Then I say multiply that by 40 over 100. You should be able to do that as well on your side there. Let's see how much this is going to give us. That gives us your 1.2 million. 1.2 million. So 1.2 million, this is the number of shares that the company had in issue at the beginning. So now I take my 1.2 million and I'm going to record it. Let's record it together. All right. So my 1.2 is going to come here. So I'm going to come here and say 1.2 million shares. 1.2 million shares. Okay. Now, these are my ordinary shares. Then I'm going to write and say ordinary shares. And At what price were these issued? We are not told. But that should not worry you. Okay? What do? Continue. All right? Whenever you see there's a figure you're not given, what do? You just continue. Let's keep going. Then we're told, on the 1st of September, the directors paid an interim dividend of 35 cents. Okay, so this is going to affect our what? Our note number 8, our retained income. Remind me when we're doing it, okay? Let's go to the next one. On the 1st of November, 40,000 shares were repurchased. 40,000 shares were repurchased at 25%, that is 60,000, above the average price. So what I know already is that here I have 40,000 shares that have been repurchased. Before I even go do certain calculations, I know the number of shares repurchased is 40,000. And whenever there's a repurchase, what do I put? Brackets. So even before I get my rand value here, what do I put? Brackets. Are we still together? Okay. Then I'm going to come here and I'm going to say repurchased. These were repurchased at what price? We don't know as yet. But that should not worry me. I am told they were repurchased at 25%, which is 60,000 above the average price. Okay, so that simply means at this point, I need my triangle. Okay, I know that at the top of my triangle, others would call it your bank. Some may call it the cash flow. Okay, and then on this left-hand side, here I'm going to get my average price. Here I get my average price. And my average price goes to note number 7. And here I will get the above or the more. Others call it the difference. And this goes to note number 8. We have been told that that amount is 60,000. That we've been told. It's 60,000. So that means I can come here. In rands, I already have it. 60,000. That is my total. All right? That is my note number 8 there. 60,000. All right? But how much was paid per share above? How do I get that? If I want to know the amount that was paid per share that is above, I would take my what? I would simply take my 60,000 and I divide it with my what? My 40,000. All right? So I'm taking my 60,000, that is what we paid above, and I divide it with my 40,000. I want to know what did I pay per share above the average price. Okay? So let's see if we can punch that one in together. Let's do it together. What do we say? We say 60,000. There is my 60,000, and then we're dividing it. We're dividing it by what? By 40,000. By 40,000. How much do we get? Then we get an amount that is 1 rand 50. So I'm coming here, I get my 1 rand 50. That means we paid 1 rand 50 above the average price. Or we paid 60,000 rands above. So these are all one and the same thing. So the examiner can give you the total amount, the 60,000, or the examiner can give you the amount per share above. In this case, the amount per share above is 1 rand 50 that we have just calculated when we said 60,000 divided by 40,000. Okay, but we are told here that that 60,000, that is 25% above. Are you still with me? Now, we want to get the average price. So that simply means whatever we paid was 125%, because we paid 25% above the average price. That simply means my average price in that case becomes 100%. Okay, 100%. So what I want, remember the UK method, what you want over what you have times what you have will give you what you want. I want to know the average price, which is 100. The average price is 100. That is what I want. 100. What do I have? I have 25. I have 25. And you can get the full amount, or you can still use your 150. Here, let me use my 150. I can use my 150 here. And if I punch that on my calculator, I'll now say 100 over 25 multiply by 150. How much do I get? You're telling me how much you get? Thank you. You get 6 rand. That means my average price here is 6 rand. My average price is 6 rand. Now I can get this top amount as well. Then the simplest way is to say 150 plus 6 rand. That gives you 7 rand 50. This is when you use the price per share. But if you're using the full amount, that is, you want to get the total amount, you would then say what you want. Remember, what you want in this case is the 100. You want 100, and what you have is 25. Then you multiply that by the 60,000 in rands now. You still with me? So it is your 100 over your 25. And then you multiply that by your 60,000 in rands. And that would give you an amount. Okay? How much do you get if you come here? Okay, let's do it together so that you can see. So what you want in this case is your 100. So let's just come here and say what we want is 100. What do we have? We have 25. All right? And then we multiply this by 60,000. Multiply that by 60,000. How much is that going to give us? That gives us 240,000. So we're going to come here and we're going to say that is equal to 240,000. So I now know that here I have my 240,000. The other way that I can do it is to simply say my 40,000 multiplied by the average price of 6 rand. How much do you get? Thank you. You get 240,000. If you say your 40,000 multiplied by 6 rand, you still get your 240,000. Okay, so you can still get the top amount in rands if you so wish. All right, so this is how we would do this part here. If we are told that we paid 25% above the average price is your 100% in this case, and therefore you are able to calculate it following the calculations that I've just done. Then the next part then says 300,000 new shares were issued. Okay, but even before I go there, the moment we get here, we are now able to get that missing amount there. Because you can see there was no issue here. All right, between the 1.2 million and the 40,000. So that simply means whatever is the average price when we repurchase shares is still again the average price at the beginning. So that means my average price at the beginning would be 6 rand as well. Okay, so I'll then say my 1.2 multiplied by the 6 rand. That will give me 7.2 million. 7.2 million. How did I do that? Because there was no new issue here between the 1.2 and the 40,000. Once I got the average price for this repurchase, that same average price would therefore be used up there because there was no new issue in between. And then there were new shares issued, which was 300,000 shares. So I'm coming here to say 300,000 shares were issued. So I'm coming here to say ordinary shares. All right. These were issued. What was the price? Do we know the price? We do not know the price. How then can we get this amount? Okay, so we want to know, how do we get that one? So we apply the bottom-up approach. Okay, let's see if we can do that together. This is how you do it. you will say on your calculator, we start with the amount at the bottom here, your 9,510,000. So we're saying 9,510,000. 9,510,000. Because we are going up, we're going to do the opposite. So that 240,000 is a negative 240, but we're going to add it now. So I'll come then and say plus 240,000, plus 240,000. And then that 7.2 million becomes negative. Then I say minus 7.2 million. All right, let's see how much that is going to give us. And that gives you 2 million. You see that one? 2,550,000. So I'll come in, then I'll get my 2,550,000. 2,550,000. Okay, let me show you again how we got that 2,550,000. We started with the 9,510,000, and then we added the 240,000, then we subtracted the 7.2. That is how we got the 2,550,000. Okay, if you're good, then we have to know now, once I'm done with my note number 7, I have to take the figure somewhere. Where do I take it? Statement of financial position. So that means let's go now to our statement of financial position. All right, so remember we have our 9,510,000, and then we are now going to record it here. So I'm going to come and say ordinary share capital. I'm going to say here that is my 9,510,000. 9,510,000. Once we are done here at this stage, I can then move on to the next aspect. Do you know which one is the next one? Definitely, we're now going to do the retained income. There's going to be a lot of calculations there. Make sure you sit close and you follow nicely. Retained income, let's go do it. There it is. And there is our answer book. We are told retained income, here we have 793,000. So that is the balance at the end there. Our interim dividends were given. Remember, they told us that the directors paid an interim dividend of 35 cents. We did have to calculate that one. That one was given. But do we still remember the format? The format of the retained income. Do you know it? Okay, please help me to fill in these blank spaces. What do we begin with? We begin with balance at the beginning. Okay, cool. So we start with balance at the beginning here. Balance at the beginning. All right? Balance at the beginning. Do we have this balance at the beginning? Were we given? No. Whenever you see it's not given, especially from the extract from the trial balance, do not worry about it, especially if the examiner has given you the balance at the end. That may mean that you have to put in whatever you have. Then you do the bottom-up calculation. From the bottom, going up. In this case, I think the examiner wants us to do that. But let's go and do it together so then we can see if that is exactly what the examiner wants us to do. What else were we given? Okay, so following our format. After the balance at the beginning, what comes next? Thank you. Net profit. Is it before or after tax? Net profit after tax. Okay, so you have to be careful with that calculation. In the retained income, we record net profit after tax. So I'm coming here, I'm just going to say NP, but you must write in full, okay? Net profit after tax. I'm doing so I can have a bracket here to show you calculations. All right, net profit after tax. Let's come to information C. We are told net profit and income tax. Income tax for the financial year was calculated as 408,800. So here we are given the amount for income tax, which is our 408,800. This is 28% of the net profit before tax. Okay, so that means we have net profit before tax, and that one is 100%. I still following. Then we have income tax, and we have been told here what percentage is it? That's 28%. So if we say net profit before tax minus income tax, we get net profit after tax. And how much is our net profit after tax? 100 minus 28. How much do you get? Thank you. You end up with 72%. Now, we are given the rand value for the income tax, which is how much? 408,800. 408,800. That is the rand value of our income tax. So we can use the UK method, the Cremora method, the what you want method, whatever way you call it. We can use that method. Let's see if we can use that method. What is it that we want? We want net profit after tax. And our net profit after tax is what percentage? That is your 72. So we want 72. What do we have? That is two values, a percentage as well as a rand. 28 over 28, multiply that by 408,800. Close bracket. Okay, let's see how much that is going to give us. So we're coming here and we're going to say, we want 72, all right? And what do we have? We have 28. And then we multiply that by how much? 408,800. Do you see that? And then let's see how much we get here. We get 1,051,200. So that becomes my net profit after tax. So I'm going to come here and I'm going to say 1,051,200. 1,051,200. After the net profit after tax, what is the next thing? The next thing becomes the repurchase of shares. It is your repurchase of shares. Okay? Do we have to do any calculations here? No, we were given the amount. Remember, we did a triangle earlier on. There, we did it. Remember, the amount that comes to your retained income is your how much? Your 60,000. So here we don't even have to open a bracket. So we just come here and then we say 60,000 in brackets. Okay. What if the 60,000 was not given? Remember, we repurchased how many shares? 40,000. And what was that amount above per share? That 150. You remember that one? Yes. Then you multiply this by 150. Then that would still give you your 60,000. That is how you would have done it if you were given the price per share and the number of shares. But in this case, the examiner was so lenient. They gave us the 60,000 already. Okay. Then the next part then becomes to calculate what we call the final dividends. So let's come here and we're going to have our final dividends. For our final dividends, how many shares do we have on this date? Okay, so you should have kept the number of shares in mind when you did your note number 7. Okay, today let's see if we can go back to the calculation that we did. Oh, you still remember the number? Okay, someone says, Mr. Simba, I still remember the number of shares. Okay, if you don't remember, let's try to do it together. Remember, we began with 40% of that 3 million, which was 1.2. You remember that one, the 1.2. And then we repurchased how many? We repurchased 40,000. So we came and we repurchased 40,000 on the 1st of September. Sorry, on the 1st of November, rather, on the 1st of November. And then on the 1st of December, we issued 300,000 shares. We issued 300,000 new shares. So the final dividend is being declared on the 28th of February. All right. And they say to all shareholders on the register. So how many shareholders are on the register? That means it's 1.2 minus 40 plus 300. I need a figure. 1,460,000. Thank you. 1,460,000. So I'm coming here to say my final dividend is being given to 1,460,000. And what am I giving? 7 cents per share. Multiply this by 0.07. That's 7 cents per share. All right. Okay. Then how much do you then get? Okay. That one you can calculate it. I don't have to punch it in on my side. You get how much? 102,000. Say it again. 102,200. 102,200. Once you have this, now you can close this part up now. Okay, so you're saying your 420 plus your 1 or 2, 200. Your 420 plus your 1 or 2, 200. And you get an amount at the top here. That is going to be 522,200. 522,200. Now the big question is, how do we get that balance at the beginning? Do you have a calculator close? All right, so I want us to punch these figures together. If you have your calculator close, let's go. You will now say, we're doing the bottom up approach, starting from the bottom, going all the way up. The first figure you're going to put in is your figure at the bottom, balance on 20th February, right at the end here, which is your 793,000. 793,000. Okay, so you have your 793,000. Then you come to the ordinary share dividends. All right, you come to ordinary share dividends, which is 522,200. But we are doing the opposite. So what do? Do we add or we subtract? We come and then we add. Then we say plus 522,200. 522,200. You see what I'm doing there? So I've added the 522,200. Then I go again, I add how much? 60,000. Then I come again, then I say plus here, 60,000. Okay? Plus my 60,000. What do I do now? Then I say minus. Minus how much? 1,051,200. Then I say minus 1,051,200. Okay, 1,051,200. And then how much do we then get? We then get a balance at the beginning of 324,000. So we're going to put it here. That was our balance at the beginning, 324,000. You saw what we did. We started from the bottom going up, and we're doing opposite of the signs. Opposite of the signs. Okay, so what we're going to do now, because we have our amount already, our balance at the end, this is what we need for the statement of financial position. Let's see if we can complete it. There it is. Our retained income becomes 793,000. Once we have this, it becomes easy, therefore, now to get your share capital and reserves. So you're simply going to add these two figures, and then you get your 10 million. How much? 10,303,000. 10,303,000. That is your shareholders' equity. How did we get that? We had our ordinary share capital, and we also added retained income. That is how we got the shareholders' equity. Now, after this, we are now going to go and complete the entire statement of financial position. All right, so what we're going to have is the completion now of the remaining parts. We're going to go for a 5-minute break, and then when we come back, we're going to complete the statement of financial position. So don't go anywhere far. I'm going to see you right back here in 5 minutes time. Welcome back. Before the ad break, we did note number 7. We also did note number 8. And I know we managed to take the amounts straight to the face of the statement of financial position. So what I have here is an extract from the records on 28 February 2023. All right, so what we're going to do, we're going to take some information from here and we're going to put it in the statement of financial position. All right, so the first thing that we have, or that we are given here, it is our debtors control. As you can see here, our debtors control, that is our 1,441,000. So you're writing it together with me. Okay, remember what I taught you here. It will start with note number 4, and then here's note number 5, and here's note number 6. Note number 4 is your what? Your inventory. So here it's going to be your inventory here. And then the one that follows, that is your trade and other receivables. Your trade and other receivables. And then after that, you're going to have your cash and cash equivalents. Cash and cash equivalents. And then you come further down, you're going to have your trade and other payables. Trade and other payables. And this becomes your note number 9. Okay, so let's quickly come up and open some brackets. So the first thing that we see here is your creditors control, which is 1,441,000. All right, so we will now go to your trade and other payables, and we come here, we say 1,441,000. 1,441,000. That is your trade and other payables. That is your creditors control. After that, you're going to have your debtors control. You see that one there? That is your 1,067,800. So that comes to trade and other receivables. Trade and other receivables. So we come here, we open bracket, and then we say our 1,067,800. And then we have cash at bank. So that comes here to my cash and cash equivalents, which is 132,000. After that, creditors for salaries. That comes to my trade and other payables. All right, creditors for salaries. This is for employees' salaries that we have not yet paid. Creditors for salaries. Then the next one is income receivable. You can hear already from its name, income receivable. That is your accrued income. Do you think it goes to trade and other receivables or payables? Definitely it goes to trade and other receivables. So I'll come here, then I'll say plus 48,000, which is that one there. And then I have income received in advance. So we've received income that we're not supposed to have received, or for a service that we have not yet rendered. Therefore, that becomes a liability. So I come to trade and other payable. So I'll come here, then I'll say plus how much? 6,600 over there. Then SARS income tax provisional payments. I'm going to put a star here. Then we're going to come back to it once we read the adjustment that pertains to our income tax. All right. Now, I want us to do this income tax whilst we still have it in mind. Okay. So what we have done, we've taken everything else and we've placed it except for this SARS income tax. And we need its adjustment. Let's go see if we can get its adjustment. There it is. We are then told that we have SARS income tax provisional payments, which is 390,000. So what we understand is that for the two provisional payments that we have made payments of 390,000. Then after we have paid 390,000, then the correct income tax has now been calculated. And we have been informed that the amount for income tax, the correct one, is 408,800. Okay, so according to our records, according to what we have already paid, we've paid 390. But what we should pay is 408,800. Okay, so what we have already paid is the 390, and what we should pay is the 408,800. So I can come here and say my 408,800. Okay, this is what we must pay, and then I then subtract what we have paid, which is your 390,000, and then you get the difference, which is your 18,800. So this 18,800, remember, we have paid provisional payments of 390, but we should pay, or the amount of income tax that must be paid over to SARS is 408,800. That simply means we must still pay. We are still owing 18,800. So it means I'll come here under my current liabilities. Then I'll say SARS, that is your income tax. The SARS income tax. I will now say what we must pay, which is your 408,800. Then I subtract what we have already paid, which is my 390,000. We are still owing SARS 18,800. When we still owe, you see it under your current liabilities there. We still owe SARS. How come we still owe SARS? Because we've made payments of 390, yet the tax for the year is 408,800. So in this case, we made less provisional tax payments than the income tax amount. So once your income tax amount is more than your provisional tax payments, that means you still have to pay more over to SARS. Next week, I'll also bring a different adjustment on your SARS income tax. Make sure you attend next week's class. Okay, so now that we understand this aspect, we have already recorded now under our current liabilities. This is one of the adjustments that normally would come in the exam, all right, where you are given provisional tax payments, amounts that we've already paid, and you are now given the income tax amount, the amount that we must pay. Then you have to compare the two. It will either go to the receivables or it will go to the payables. It will either go to assets or liabilities. In this case, we take it to our liabilities because our provisional payments are less than the income tax that we must pay. Therefore, we still owe SARS more, which is 18,800. Okay, let's quickly move on now to the next adjustment. So that was adjustment C there. That was adjustment C. Let's see, there is adjustment D. Adjustment D. And it reads. So adjustment D now pertains to the fixed assets of the business. All right. So as you can see here, we have our land and buildings, which is already put in the answer book for us. But we have equipment here, and it has not yet been recorded. So I'll come in, then I'll say plus 600,000. So the examiner can test you in this way, or we can also go to note number 3. Or we go to note number 3. All right, so your fixed assets, it is your 8,532,560 plus the 600,000. That is the equipment at cost. Then we are told, all right, that all equipment was purchased on the same day, on the 1st of October 2020. Depreciation is written off at 20% per annum on cost price. There was no other changes in fixed assets. Current depreciation has been recorded. Okay, so in other words, they're telling us that the current depreciation has been recorded. So what we now need to do is to see if we can do some calculations over here. Now, you have to remember that once you buy an asset, it will lose value to depreciation. And there are two methods that we use to calculate depreciation: your cost price method as well as your diminishing balance method. In this case, we are told that we are going to use the cost price method. Okay, but one of the interesting things is that this asset was purchased on the 1st of October in the year 2020. Okay, so that means we need to go back in time for us to calculate some amounts. Let's go back in time and calculate some amounts. If it was purchased on the 1st of October, 1st of October, the year 2020, and then that financial year would then end on the 28th of February, the following year now. That would become 2021. I want to know how many months are there. So we need to count. Let me see your fingers. October, 1st of October, because, so we're going to count October because it's 1st of October. So it's going to be October, November, December, January, February. How many months is that? 5 months. Let's go on. That was the first year that we had the asset. So we would calculate depreciation here, and then we would say depreciation is going to be calculated by saying 600,000, and the rate is 20%, and this was therefore 5 over 12. So our depreciation in this year was going to be how much? That was going to be your 50,000. That will give you 50,000. Okay, so in that first year, the assets lost 50,000 due to depreciation. Then we go on to the next one, which is now beginning on the 1st of March 2021, and it stretches over to 28 February 2022, and these are 12 months. We would then say 600,000. Multiply that by 20 over 100. Multiply by 12 over 12. How much would that give you? That will now give you 120,000. So here we get our 120,000. Then remember, the financial year ends on 28 February 2023. That means I'll come again the 1st of March 2022. We stretch over until the 28th of February 2023. That will give us again 600,000. You multiply that by 20 over 100. Multiply again by 12 over 12 months. It will give you again the 120,000. 120,000. So it therefore means my total depreciation would then be 50,000 in the first year plus 120,000 in the second year plus 120,000 in the very last year here. So that would give me 290,000. So I'll come here, then I'll say minus my 290,000. That would be my depreciation, minus 290,000. The other way that you could have done it, which was the simplest way or the quickest way, would be to say, you take your 600,000, and then you say, multiply by the rate, which is 20 over 100. Then you multiply by how many months? Here you have 5 months. Plus 12. 5 plus 12, that is your 17. Then plus another 12 here. That will give you 29. Okay? So then you have 29 months. 29 over 12. Then it should give you your total amount, which is your 290,000. Then you bring it here, 290,000. Then we close the bracket in that case. If we close the bracket, how much do we then get? 8,842,560. That becomes the fixed assets value at the end. So in this case, we're given an asset that was purchased some time back in the past, and we're to calculate depreciation year by year by year until we get to this current year. Okay, then let's quickly move on to the next aspect. The next aspect has to be our fixed deposit. Let's see what it says. Adjustment E, and it reads, the fixed deposit is invested with Absa Bank. Note that 25% of the fixed deposit will mature on 31 August, while the balance will mature in 2025. So what this means is we have a fixed deposit which is part of our non-current assets that is 12 months and more. Remember what I said at the beginning. These are assets that last for more than one financial period. But now we're being told that 25% of this fixed deposit will mature on 31 August. Where we are presently, we are on 28 February 2023. And if we count on to get to 31 August, if we're to get to 31 August, you realize that these months are less than 12 months. The moment that part of the fixed deposit is going to mature in less than 12 months, it will cease now to be a non-current asset, but then we consider it in a current asset now. So we take it from our non-current asset because it's going to mature within the next 12 months. Then we record it under our current assets. We're going to realize that cash in our bank account within the next 12 months. So that would mean I would then come here and then I would say my fixed deposit, the amount is 806,000. And I'm told that 25% of the fixed deposit. So I'll come here, then I'll say 806,000. Multiply that by 25%. Okay, let's quickly punch that in the calculator. All right, let's do it together and see if we are able to get it. So we will now say our, okay, I think we went to the next adjustment there. Okay, we're here. So we'd say our 806,000, that is our 806,000. Then we want to get 25%, multiply by 25%, okay? And then we will get the fixed deposit that will mature. That is going to be your 201,500. So that 201,500, I'll then come and say here, minus 201,500. Then I'll come and add it now to my cash at bank here. So I'll come to my cash at bank, then I'll say plus 201,500. Let me explain this again. Once a fixed deposit is set to mature within the next 12 months, in this case, it's from in the next few months, because in August already, it's going to mature. So that is within 12 months. We take it from the non-current assets, then we record it under current assets. So we took it from here and we record it here. That is how we do when a fixed deposit is set to mature within the next 12 months. We take it from the non-current assets, then we record it under current assets in cash and cash equivalents. Then we close this bracket. Then we end up with 604,500. So we come here, it's going to be 604,500. Okay, let's quickly now come. I want us to get our non-current assets figure. You have your calculator with you. Say 8,852,460 plus the 604,500. And then you get your 9,456,960. So that becomes our non-current asset figure. Okay, I know we still have more adjustments to do, so let's quickly go. The next one is your loan adjustment. Loan from the director. And it reads, a loan of 3 million from one of the directors was originally received on the 1st of March 2021. This loan is to be repaid in equal monthly installments over 5 years. All payments up to 28 February were made. Interest is not capitalized. Very key that we know that all payments up to the 20th of February were made. Okay, let's begin. This loan that we received, we are supposed to pay it over how many years? 5 years. That means I'll come here, then I'll say my 5 years, multiply that by the number of months in a year. So for how many months were we supposed to pay this loan for? For 60 months. We're supposed to pay this for 60 months. Okay, now we want to know for how many months have we paid so far. It was originally received on the 1st of March 2021. So 1st of March 2021. And then we went on until the 28th of February 2022. How many months would that give you? That will give you 12 months because it's one financial year. Okay? And then we come here again, 1st of March 2022, and then we go to 28th February 2023, which is where we are now. All right, that will give you again how many months? 12 months. You still following me? So in total, this loan we have paid because we have been told all payments have been made up to date. In other words, we have made that 12 and this 12. In total, we have made 24 payments. We're still okay. In total, we have made 24 payments. That is for 24 months. We were supposed to make it for 60 months. So we'll now say the 60 that we're supposed to pay. All right. Now, how many months do we still owe? We say 60 minus the 24. That is now going to give us how much? That will give us your 36 months. The 36 months. Okay. But this loan that we received, the loan of 3 million from one of the directors. So we received the loan being 3 million. So that would then mean I would come here and I would say that loan that we received, which is my 3 million, how much have we paid so far? Several ways in which you could have done this. You could have said your 3 million divided by the 60 months that we're supposed to pay it for. That would mean that we must pay how much per month? If you say your 3 million divided by 60. Okay, let's quickly do it together. If you say your 3 million divided by 60, so we're coming here, that is your 3 million. Okay, so we divided by the 60 months that we're supposed to pay it over, divided by the 60 months. Therefore, we are paying how much per month? 50,000 per month. So we'll come here, we're supposed to pay 50,000 per month. All right, now we have been told that all payments have been made up to date. That simply means we have made payments for 24 months. I would then say from that 3 million that we had borrowed, we have made payment for the first 12 months. And for the first 12 months, when we were paying 50,000 per month, that would mean that we're paying 600,000 per annum, per year. So in the first year here, in that first year, we paid the 600,000. We paid the 600,000. Okay? Okay. Actually, let me come and do it over here. Let me do it over here, where I would say loan. The loan was for 3 million. I'm just showing you the calculation here. So far, we have paid the first 600 for the first year, 600,000. And we also paid another 600 for this current year. Another 600,000 for this current year. We know now that from the 3 million, we have subtracted 1.2 million. So in other words, we only owe 1.8 million. We only owe 1.8 million. But from this 1.8 million, we are going to pay another 600 again within the next 12 months. I'm going to say it again. So far, we have paid for the first 12 months, which is this one here. And we've paid again for the second 12 months, which ends on the 20th of February 2023. We know that within the next 12 months, because we make monthly installments, so we can actually say next month we're going to pay again another what? Another 50,000. So once we're going to pay it in this short term, it will cease now to be a non-current liability and it becomes a current liability. Any loan that we are going to pay within the next 12 months, because this we've already paid, that we've already paid, but we know in our minds we're going to pay again in the next 12 months. How much are we going to pay in the next 12 months? Another 600,000 again. But that one will now come down here and we call it current portion of loan. Current portion of loan. So that would mean that at the top here, I'm now going to have my 1.2 million. And here at the bottom, I'm going to have my 600,000. Remember, we still owe this director 1.8 million, but only the 1.2 will be paid in the long term. The 600,000 is going to be paid within the short term. So it comes under my current liabilities, which is a 12 months and less, because your non-current liabilities is a 12 months plus. So that is why we took down the 600,000 from the non-current liabilities. Okay, very, very important that you understand this aspect. Where did you see us doing this again? When we were doing the fixed deposit, we did a very, very similar thing, exactly the same thing. So this is what we were doing here. We took a loan that is going to be paid within the next 12 months. We take it from our non-current liabilities and we record it under our current liabilities. And therefore, our non-current liabilities are your 1.2 million here. All right. We are now coming to our very last adjustment, which reads, a debtor's debit balance of 1,000 in the debtor's ledger must be transferred to his account in the creditor's ledger. Okay, so what this means is we have a debtor's ledger here. Remember, an asset, so here is a plus and here is a minus. And we have a creditor's ledger here, which is a liability. Here is a plus and here is a minus. And we have a debit balance of 1,000. Here is a debit balance of 1,000 in the debtor's ledger. But we are going to transfer this to his account in the creditor's ledger. So this can be a situation, this can be one of the possibilities, that we have a business that is both a customer to us, that is a debtor, and also a creditor. So they buy from us and we also buy from them. So in our books, we also have them as a debtor as well as a creditor. So what then is going to happen is, in the debtor's books, they owe us 1,000. Okay, so we're going now to come and transfer this to the creditor's ledger. Remember, the creditor's ledger, this is where we keep people or businesses whom we owe. So we are now coming to say, we're going to take him out of the debtor's ledger where he owes us. And then we're going to say 1,000. So we have removed this amount from our debtor's ledger as if we have received payment. Then that would therefore go and decrease the amount that we owe them as if we've paid them. Are we together? Because we have an amount, a debit balance in the debtor's ledger. That simply means the debtor owes us. But the very same debtor is also a creditor. We owe them. So we are going to take an amount that they owe us, all right, and we're going to record it on the credit side as if they have paid us. Then we go to the creditor's ledger, then that same amount offsets the amount that they owe us as if now we are paying them. So you would see that in our debtor's ledger, it would decrease, and in our creditor's ledger, it would decrease. So what we simply did is to transfer that amount there. That would mean we'll come now to our trade and other receivables. Remember, we have already done some adjustments there. Debtors control, where you have your 1,067,800. Then you would come, what was the sign there? That's a minus. Minus 1,000. And I would come here to my current liabilities. That is my trade and other payables. Under my trade and other payables, I will then open bracket, and then how much do I have? My trade and other payables, it's 1,000,000 441,000. 1,441,000, and then I'll come and say minus 1,000. So we subtracted from our debtors, that amount is no longer there. Then we also subtracted in our creditors, that amount is also no longer there. All right, and then once the statement of financial position is completed, it would appear as something like this. All right, so we did that part, you'd remember, and then here you would simply come and close over here, and then you get your total assets. Then remember, we did our ordinary share capital, note 7, we did note number 8, which is that one, which gave us the ordinary shareholders equity, and then we would also come and close down here, that is our current liabilities, to get that one. Don't forget, we already did our non-current liabilities, that was the loan. Okay, next week I'm going to do a very, very interesting statement of financial position. All right, so what I want you to do is to tell your friends that next week Mr. Simbi is going to be there exactly at 2, and we're just going to take it for 1 hour 30. What you need to do is to bring your pen, your pencil, your calculator, but the most important thing is I need you in my class. So I hope to see you next week in this class, that we can continue with the statement of financial position. We are not going to wait until we start writing our control test. We're not going to wait until we start writing the June exams. We're going to start practicing and preparing for exams right now. Remember, every time you invest in your education, there is a fruit that you're going to reap in the coming year. And I know that you're going to get good results in the coming year. Thank you so much for being in my class. It is such a joy to have you, and I look forward to seeing you next week. From me, it is goodbye.